In late February, Blackmore's CEO departed suddenly, a week after their first result, and this precipitated by a 23% fall on results day, which saw the stock slump to a 3.5-year low. This is unfamiliar territory for the former market darling that went from $21 in 2010 all the way to $217 in 2016. This has seen the major shareholder, 72-year-old Marcus Blackmore, step back into the CEO's chair as the vitamin maker searches for the new CEO. With all this turbulence, Blackmores is cheaper than it has been in many years. But is it a buy? Hugh Dive from Atlas Funds Management is going to answer that. Good morning, Hugh.
Good morning, Chris.
So a lot happening with Blackmores. They've been up significantly, very quickly, and then come down in a tumultuous ride over the last few years. We've all seen that in the media, but what's the backstory of Blackmores?
Right, so Blackmores is one of Australia's largest vitamin and supplements brands. Generally has about a number 2 market share behind Swiss. They sell around about half a billion vitamins capsules a year, around across about 250 products. And this is all after starting out from one health food store in Brisbane in 1938. If you look at the split, it's Australian vitamins, about 30% of the revenue. Nutrition, so that's protein powders and the like, and supplements, about close to 20%. Other Asia, 15%, and then China, which is about 35%, including exported products coming out of Australia. So that's where a Chinese person, a tourist goes to an Australian store, buys a whole of Blackmore vitamins, and then posts them back to China. So looking at the Blackmore story, the founder's son, Marcus Blackmore, has been a key driver in the business growth since taking over in 1975, so a lot of longevity of management, and he's expanded Blackmore's inside Australia and then outside into the high-growth Chinese nutritional supplements market, and that's leveraging off Australia's clean, green brand into a market which China, which has a range of scandals, which has damaged consumer trust in domestic Chinese vitamin brands. And the Chinese market has been a key reason why people bought Blackmores, and because it's a big opportunity set of around about 60 billion sales per annum, and it's strongly influenced by foreign manufacturers that command around over 50% market share, and Blackmore's got about 1% of that. So after stepping, as you mentioned, after stepping back 5 years ago, Marcus Blackmore, the founder, is now back acting as the CEO.
You said you said the 1% of the Chinese market. So it sounds a bit like an early 2000s widget sales pitch.
Blackmore's business model is relatively simple, and they manufacture vitamins or health supplements, so generally a bit of active ingredient pressed into a pill. Primarily they're plants in Australia. The Australian market's much smaller, it's about close to $3 billion per annum industry. But it's been supercharged by Chinese shoppers buying vitamins to send back to China, being sold at a profit to the Australian retail price. So Blackmores has got around about 17% of the Australian vitamin market, just behind the Swiss, as I mentioned earlier. Vitamins is not a bad business to be in that unlike drugs produced by pharmaceutical companies such as Merck or CSL, the ongoing research and development involved is actually quite minimal for Blackmore's vitamin tablets. Additionally, complementary medicines and supplements don't have the same degree of testing and regulation as prescription drugs, and that really reduces development costs. So conversely, other health or companies broadly in the health space, such as CSR and Cochlear, are forced to constantly reinvest in R&D just to stay ahead of their competitors.
So what kind of percentage would Blackmore spend on R&D, and why is it less important for them to innovate than, say, CSL or Cochlear?
Well, so think about the case of, say, Cochlear. They've always got to reinvest in R&D to come up with new hearing devices because their competitors are constantly improving their offering. A tablet of vitamin C or some vitamin E cream is pretty much what it is, or a tablet of fish oil. Hasn't changed dramatically in the last 20 or 30 years, so there's no need to spend vast amounts of R&D, because it is what it is. So that results in vitamin manufacturing being quite a high margin business, with Blackmores having gross margins of greater than 60%, And really the key differentiator is to maintain market share is really advertising, with that Blackmore spending about 9% of group sales and marketing. So you could probably think that instead of R&D, you're probably spending money on marketing to try and maintain market share.
And the CEO's exit, that's obviously a concern for investors, and the quality of the board is something that you look at in the quality filter model. So if we apply those standard metrics and look at Blackmores in that way that Atlas does, we start off with the financial leverage, and that's obviously a critical component for a large growth company. How do you rate the leverage that we've seen in Blackmores and that we see today?
Well, yeah, I mean, here Blackmores scores quite well. Corporate gearing around about 15%. A lot of that's only been taken on to fund marketing spend in China. Interest cover over 20 times, but excellent metrics. This is a relatively sort of capital-light business that doesn't involve massive amount of sort of capex to remain in business. So it scores quite well on that metric.
And you mentioned that the growth into China has been quite significant, and we've all seen that over the last few years.
Yeah.
How do you rate the growth of expansion, not just China, but for the whole company?
Well, here Blackmore scores quite well. We've had 11% compound growth. Revenue growth the last 5 years is very high, but this has been achieved by organic growth in new markets rather than acquisitions. However, that score is quite skewed by very much a big outlier of 2016, which saw enormous growth, which has suddenly been sort of shut off. So overall, it scores quite well, but we'll probably discuss that in the regulatory risk portion there a bit later on.
And the corporate governance, so we look at sort of the board, the segregation between chairman, managing director, CEO, tenure, and so on. How's Blackmores look here?
So sort of in this category, there's a lot going on for Blackmores. So Blackmores scores quite well in terms of disclosures, ESG, and that's not really surprising for a health and wellness group. It's not like some evil sort of weapons company. They're always going to score well because it's very much part of the image of the company. However, looking at the board level, Blackmores, as we discussed, is in flux as the company searched for a new CEO after a very sudden and unexpected departure in late February. The Blackmores chairman can't really be categorised as independent, as he's been on the board for 14 years. Looking at the rest of the board, there's 5 independent directors, as well as the current CEO is also a major shareholder. So all in all, Blackmores probably gets an above average mark. Normally we'd mark down for board composition, but having sort of the major shareholder step in to protect his investment is understandable. Marcus Blackmore owns about 23% of the company. It's sort of understandable for a company in flux, and he's obviously sort of very motivated to sort of fix some of the issues inside Blackmores to protect a large chunk of his own personal wealth.
And is that something you'd normally mark down, having a large shareholder come back in to drive the board?
Not necessarily. What we're looking at more is just the degree of independence within the board, and also how that large shareholder acts. Historically, unlike some other sort of large shareholders, Marcus Blackmore has actually acted in the benefit of other investors. Sometimes we look at, say, for example,
Harvey Norman?
Harvey Norman or Kerry Stokes, where they can tend to run the public company as a private company. I haven't seen any evidence of that here.
And then we move to regulatory risk. So we mentioned the Chinese market. Yeah. There's a lot happening there.
Yep.
How do you digest that?
So here Blackmore scores below average. Whilst the regulatory risk in the mature Australian market is quite low, investors are really paying like a high PE, so over 25 times, to get access to Blackmore's sort of growth in the high-growth Chinese market. So as I mentioned before, Blackmore's had a very stellar 2016 with quite a surprisingly jump, and that's resulted in the share price climbing from sort of $100 to $215. But that was a little bit of a one-off. So Blackmore's, this stellar 2016 resulted was Chinese tourists were buying Blackmore's products domestically and then shipping them back to sell in China for profit, thus bypassing a range of tariffs and duties.
So you're talking about that sort of past tense.
Yes, that loophole was shut down in 2017, and that sort of resulted in significant product oversupply in Blackmore's domestic channels, as if they'd stuffed their domestic channels, assuming that those Chinese Diageo or foreign would come here and buying products off Australian shelves. We all remember those sort of those headlines, they're trying to limit foreign buyers. But so they had too much stock in there, and that resulted in inventory destocking and discounting, leading to issues in 2017 and 18. This also resulted in Blackmores changing their China strategy from sort of online and domestic sales to Chinese tourists to trying to deal with mainland Chinese-based distributors. They're a much more traditional model. Additionally, sort of China is now offering greater regulations requiring these sort of products to be registered with China's authorities, and that's sort of creating bottlenecks. So pulling this together, so the regulatory risks are sort of relatively high here. Especially, I think, if you look in the long term, the Chinese government had a long-term history of trying to promote domestic brands, and they'll be looking at this $60 billion industry and looking to potentially try and favour domestic brands at some stage. So that's a bit of a worry there. Also, as we're seeing with the coal, Blackmores could end up getting coal imports into China at the moment. Blackmores could end up getting caught up in a political football between Australia and China. You can't discount that occurring there.
So this first move by the Chinese government to regulate these types of products, is that something that we have in Australia or we've seen in other parts of the world?
We had that in Australia, yes.
Okay, so that first move is not too unheard of, but it's not a great trend to see.
No, I mean, you might remember seeing sort of great pictures of entrance halls into Beijing airport with abandoned cans of Bellamy's milk formula and vitamins when this came through a couple of years ago, when suddenly the duties were being applied to products being bought in people's suitcases and the shoppers abandoning them at the airport.
Yes. And so the final part of the quality filter model is looking at the technological and operating risk. And rounding this out, it seems like the risks were high with the tourists becoming distributors, being the largest growth part of Blackmore's market. And then they're also talking about reducing the dependence of online sales in China. It seems to be kind of an opposite to most consumer products. So how do you view that overall technical and operating risks for?
So unlike sort of Orica making explosives and Blackmore's making vitamins, there's a pretty low risk in the operational risks because it's an established process that Blackmore seem to have mastered, so with minimal product recalls over the last years. Though there are some technological and operating risks that lurk below the surface in this company. I mean, despite sort of Blackmore's having good brands, they do face the technological risk in that a lot of their key products have been susceptible to being produced by competitors or new entrants attracted to the high growth in the space. I was looking at some of their biggest sellers this morning, key products such as their vitamin E cream or fish oil tablets or even primrose oil and celery tablets. There are minimal barriers to entry other than marketing spend, so it's a strength for Blackmores in terms of they don't have to spend a large amounts of R&D each year, but these are products that can be quite easily copied by competitors, so they score poorly there. Another operating risk that Blackmore's face is the emergence of the chemist warehouse, which is adopting what Bunnings did to hardware in these big box corporate warehouse style pharmacies and models in Australia. I personally shop there. I think it's a good shopping experience. But this group has really expanded to around about 30% of Australia's pharmacy turnover and around 60% market share in vitamins. So this is a big concern there for Blackmores. So because this degree of consolidation was likely to cut into Blackmore's margins, with Chemist Warehouse now accounting for around about 25% or a quarter of Blackmore's sales. And it's a very dangerous position for any manufacturer to be in. I mean, the risk here is that Chemist Warehouse sort of further develop their own home brands, or even threaten to destock Blackmores unless sort of significant rebates are given. We see how Coles and Woolies have operated with these sort of big suppliers. Even suppliers with excellent brands such as Coke have felt the sting of the market power of the distributors.
So you've definitely got Coles and Woolies, mentioned Bunnings, Deliveroo have more recently opened their own kitchen, compete with the restaurants they've been delivering for. Amazon cut out the middleman of the entrepreneurs. Yeah. They've got the buyer and the supplier, and then suddenly they've got their own product.
No.
Can we learn from these other consumer markets and provide insights and timeframes, whether it's airlines or anything like that?
I mean, generally, a lot of it depends on when the distributor decides to flex their muscles. So it's a bit hard to say that. But having looked at this and looked at it, say, with Flight Centre and Qantas, in that after a while, Flight Centre, they were selling an awful lot of Qantas flights. They started asking for bigger and bigger rebates in order to continue selling Qantas. And I think it was a couple of years ago they threatened to favour Emirates over Qantas, and that sort of had a big impact on Qantas' sales. So it depends on when they want to flex their muscles, but what is very clear is at some stage that distributor will use their market power. And yeah, that's a bit of a concern if I was buying Blackmores today.
So we've got a few concerns and a few high scores on financial leverage and the like. Yeah. Does it come out to be Blackmores as a buy or a caution?
I mean, whilst sort of Blackmores is trading at sort of about half price from its 2015 peak, we wouldn't add it to the portfolio as it just narrowly fails the quality filter model. I mean, another factor is looking at valuation. So given the risk that Blackmores face, investors are being offered a very minimal margin of safety, with Blackmores still trading on 25 times earnings with a relatively skinny sort of 3% yield. We wouldn't add it to the portfolio. It's not cheap enough for us here, given the risks that are, especially on the tech and operating risks that are still ahead of them.
That looks like a lot of concern, especially with the board as well, and all those metrics you've just walked through. That sounds like an avoid, so thank you very much, Hugh Dive from Atlas Funds Management.
Thanks, Chris.